Hello and welcome to Learning with CS Anand Kankani, and this video is going to be helpful for all those students who are preparing for CS professional exams or who are preparing for CS executive exams. And in this lecture, we are going to cover the SEBI SAST regulations, or what we call as a takeover regulations. This video is going to cover the introduction and the definition part of the takeover regulation. Thereafter, you may find a series of some 9 to 10 more lectures, which is going to cover the other aspects of the takeover regulation. Some that I have noted down is the next video will cover trigger. The next video is going to cover the delisting offer, that is the regulation number 5A, which has actually got amendments, and then voluntary offer. So this way I'll make short videos, but there's going to be series of videos which you are going to come across. Now, without wasting any time, this regulation is called as substantial acquisition of shares and takeover regulation. Now, what is substantial is not defined in the regulation. What is takeover is not defined in the regulation. What is defined is there is acquisition and there is shares. Now, even though the regulation name is substantial acquisition of shares and takeover, but it is not just the shares which is going to be important or which is going to be relevant in the entire takeover regulation. You will find shares, you will find control, and you will find voting rights. So these three terms you are going to come across a lot of time. So acquirer is going to acquire share, control, voting rights over the target company. What is acquisition is again simply defined in the regulation. Acquisition is when a person who is called as acquirer acquires the shares, control, or voting rights. Now, voting rights, control, shares of whom? It will be acquired of a target company. So let's understand each and every term in detail. In this video, like I said, we are going to only cover the introduction and the definition part. That is going to be very, very relevant for you for the further lectures. So in the takeover regulation, what happens? There is a person whom we called it as a acquirer. Now, who is an acquirer? Acquirer is any person. It can be, the acquirer can be an individual, the acquirer can be a company, it can be a LLP, it can be a body corporate, it can be a AIF, any person. So it's a vast definition. So anyone can get included here. So there is a person, acquirer. Acquirer is acquiring, or the acquirer agrees to acquire. So even if you agree to acquire, right, go back to the Contract Act. The Contract Act says that once you, or if you see the Sale of Goods Act, like if you remember that from the foundation, the Sale of Goods Act says that the person who buys is a buyer, the person who agrees to buy is also a buyer. So same thing goes here. Acquirer definition has got two parts. One, the person who has actually acquiring or who has actually acquired, or the other person who is agreeing to acquire. But acquire what? The acquirer may acquire shares, the acquirer may acquire voting rights, or the acquirer may acquire control, and this would be over the target company. Now, what is a target company? Target company is a company, or it can be a body corporate, which is listed on the stock exchange in India. The company or the body corporate whose securities are listed on the stock exchange in India, that company is called as a target company. So if an acquirer acquires shares of an unlisted company or acquires voting right or control over an unlisted company, then in that case, the takeover regulations will not come into picture. But this sentence will again be subject to certain terms and conditions. And why? Because regulation number 1, sub-regulation 3. So all those who are not new to my channel, you know that I have been teaching through the Bear Act, and that is the base material with which I teach. And all those who are watching this lecture for the first time, I always take help of the Bear Act or the Bear regulation, because that is the best place where I think the most authentic information would be there. So throughout the session, either you are going to find the blank screen or you will have the extract of the Bear regulation. So regulation number 1, sub-regulation 3, it says that these regulations will apply to the direct as well as the indirect acquisition. Now again, like I said, you'll find share, control, or voting rights. So you'll find shares, voting rights, or control over the target company. Now, what is direct acquisition? What is indirect acquisition? So just see this diagram. I said what is happening here? Acquirer is acquiring shares, control, or voting rights over the target company, right? Now, when I say direct acquisition, so in case of a direct acquisition, the acquirer is going to acquire share control or voting rights over the target company. So there is no intermediary, or there is no intermediary in between the acquirer and the target company. There is no other entity. But when I say indirect acquisition, now this will be very relevant when we do regulation number 5. This again we are going to discuss there in detail, but just to give an idea, here you have the acquirer and you have the target company. So instead of the acquirer straight away acquiring the shares of the target company, there is a entity here. Okay, so acquirer will first acquire control over this entity, and once acquirer gets control over this entity, then whatever the shares or the voting rights or control this entity has over the target company actually belongs to the acquirer. But understand, this is very important. This is very important that acquirer first needs to get control over the entity. A lot of time when I ask a question that, for example, acquirer has acquired 40% in this entity and this entity holds 20% in the target company. So what is the indirect acquisition? Now, if your answer is okay, you can write it in the comment section what your answer is, and then you can check whether your answer is correct or wrong. So either you must have answered 8%, or your answer must be 20%, or your answer must be 0. I don't think so any other option would be there in your mind. But the logic to this 8% is 40 into 20. So most of the people who do this multiplication, please don't do this. This is the most incorrect answer. 8% is not the right one, because we don't do this multiplication here. So either there is an indirect acquisition or there is no indirect acquisition. So either the answer is 20 or the answer is 0. But just see what I said. The step 1 is acquirer needs to get control over the entity. Now acquirer has acquired only 40%. Now, with 40%, if the acquirer has got control over the entity, then in that case, we will say the acquirer has indirectly acquired this 20% in the target company. But with 40%, if the acquirer does not get control over the entity, then the acquisition, like there is no indirect acquisition, there is 0. Ideally, to get control, you need more than 50%. Even though the definition of control does not provide more than 50%, but for control, you understand you need more than 50%. Even with less than 50%, you can get control, but that's, I think, not very much relevant for the academic side. For the academic side, you need, if you need control, the control should be more than 50%. Now, since the acquirer is holding only 40% in this entity, so there is nothing this entity has acquired in the target company. But if I change the answer and let's say I make it 60%, or let's say 70%, the acquirer has acquired 70% in this entity, then what this entity holds in the target company, the answer would be entire 20%. Because if the acquirer has got control over this entity, then whatever this entity holds in the target company belongs to the acquirer, and acquirer is said to have acquired these 20% shares indirectly in the target company. However, in case of direct acquisition, there is no such intermediate organization or entity, and you can straight away acquire. Now, coming back to this, like I said, the target company means a company which is listed on the stock exchange in India. This entity may or may not be a listed company. This entity can be a LLP. This entity can be a private limited company. It can be a unlisted public company. Doesn't matter. But again, will this entity be a target company? No, the target company will always be the one which is listed on the stock exchange in India. So this is one situation where even though you don't actively acquire the shares, control, or voting rights over the target company directly, but through this entity, you get the SAST regulations getting attracted. Now, moving ahead, some of the definitions, like I am straight away starting with the offer period, because a lot of the definitions I have already covered, like the definition of acquirer, the definition of control, the definition of shares. Now, shares, I'm going to cover it in later stage. So just check this definition, the definition of offer period. Sometimes you may get this question in the answer. Now, what happens? The SAST regulations, broadly, if you see, it provides you 3 things, right? First, it tells you about the trigger. And when I say trigger, it is the obligation to give an open offer. Then the next part is it says exemption. So for example, you have triggered the open offer, you have hit the trigger, but the regulation says that, okay, if you have hit the trigger in certain circumstances, you need not give the open offer. Thereafter, you will find the open offer process. How the open offer process, once you hit the trigger, how the open offer process is to be carried on. Thereafter, you will find some obligations on the target company, obligations on the acquirer, obligations on the board of directors. So all these things you're going to find. And towards the end, you're going to find the disclosure requirements. Right now, when I say open offer, so when does the open offer begin and when does the open offer end? So like I said, you have the open offer process. So open offer starts with something called as public announcement. So first of all, once you hit the trigger, you have regulation 13, which tells you when the public announcement is to be given. So in certain cases, you hit the trigger, you give the public announcement. In certain cases, you give the public announcement only, then you hit the trigger. And in certain circumstances, you hit the trigger and thereafter you give the public announcement. So depending on in which type of acquisition you have done, so you give a public announcement, thereafter you come up with something called as detailed public statement. After this detailed public statement, you go to SEBI and you file your draft letter of offer, which SEBI gives you a clean nod, and then that letter of offer becomes, the draft letter of offer becomes the letter of offer, which is dispatched to the shareholders. Thereafter, your tendering period starts, where actually the shareholders of the target company, they give you the shares pursuant to this open offer. This tendering period is a time period of 10 days, and once this tendering period ends, thereafter you pay the purchase consideration and you actually complete the acquisition. So this is what is open offer. Now if you see this definition, the definition of open offer starts from here and it gets ended here. A lot of the, I mean, if you are not very much clear about the takeover regulation, I have seen people saying this entire period is not the open offer, or this is the open offer period, right? Where you actually tender the shares, or tendering period is again the open offer. So they get confused in this part. So understand, there are two parts. One is the offer period and the other is the tendering period. This is called as the tendering period, which is for a period of 10 days. And the offer period starts from once you hit the trigger or you give a public announcement, and it ends when you pay the purchase consideration. So the tendering period is a gap of, or it's a period of 10 days within the offer period. So you see this offer period means the period between the date of entering into an agreement, formal, informal, to acquire shares, control or voting rights or control over the target company, requiring the public announcement, or it can be the date of public announcement itself, and the date on which the payment of the purchase consideration or the consideration is paid to the shareholders, or let's say it may happen that your open offer is withdrawn. So if the open offer is withdrawn, there and then the offer period ends. So when does the offer period starts? The offer period starts from the public announcement and it ends once you pay the purchase consideration or when the offer is withdrawn. You get this question in your exam: what is the difference between offer period and tendering period? So the definition of tendering period also I have covered it here. What is tendering period? So tendering period means a period within which the shareholders may tender their shares in acceptance of an open offer to acquire the shares made by under these regulations. So tendering period and offer period, these are the two definitions which you should know. The next most important definition from your exam point of view is the definition of person acting in concert. If you get a 5-mark question, if you get a 4-mark, or if you get a 7-mark question on what is person acting in concert, do start with this part, that the definition of PAC is divided into two parts. You have the first part, which is where SEBI has tried to identify and demonstrate that who can be called as the PAC, and you have the second part, which actually comes into the category of deemed PAC. So it's similar to your insider trading regulation. You have certain person who is called as insider, and then there are deemed insiders, right? So this is a deemed connected person, right? So you have this person acting in concert. So who is a person acting in concert? A person acting in concert means a person who, with the common objective or the purpose of acquisition of shares, control or voting rights, or control over the target company, which can be pursuant to an agreement, understanding, formal, informal, directly, indirectly, they cooperate for the acquisition. Now understand this part. When I say takeover regulations. We just discussed this. What happens in case of takeover regulation? You have the acquirer who is acquiring the shares, control, or voting rights over the target company. Now, along with this acquirer, let's say the acquirer is A. Along with acquirer, there are other three people, let's say P, then Q, and then R. They are also acquiring the shares of the same target company. Now, in this case, we'll say A is the acquirer and P, Q, R, they are the person acting in concert, and they are person acting in concert with A because they are acquiring the shares of the same target company in the same fashion, in the same, with the same reason why and how A is being acquired. They are acting collectively and they are doing it. So that's where the definition of person acting in concert comes into picture, because all the obligations and the takeover regulation which falls on the acquirer automatically also falls on the person acting in concert. So understand, two people, they are acquiring the shares of the same target company with the same intention, and that intention can be established. How will you establish the same intention? The same intention can be established by way of an agreement which those two parties have executed, or those two persons have a understanding, which can be again formal or it can be informal. They may agree to acquire directly or indirectly, right? So they cooperate for the acquisition, and in that case they are called as the person acting in concert. So in this case, the onus of proof lies with the SEBI. In this case, SEBI needs to prove. Here, SEBI needs to prove that these two persons are person acting in concert. But then there are certain category which SEBI has established, where SEBI says that to these people we believe that they are by default person acting in concert. For example, a father and a daughter, they are acquiring the shares of a target company. SEBI would say, see, they are immediate relatives. Okay, since they are immediate relatives, we believe that they both are acquiring the shares of the target company collectively. So in that case, SEBI need not establish any agreement or understanding between the father and the daughter. Just by the relation, SEBI has deemed that these two people are acquiring shares with the common intention. However, there is a caveat here which says that unless the contrary is established. So let's say two brothers acquiring the shares of the target company, same target company, and those two brothers are financially independent. Their other operations are segregated. Maybe there was a division in the family, so everything is being segregated, and those two brothers are acquiring the shares of the target company. Then in that case, they have to establish those segregation, and thereafter they will fall into this category 1, where then SEBI needs to prove that even after the family separation or even after financially being segregated from each other, still they need to they are still acting in concert because they have a understanding or they have a agreement between them with the same intention to acquire the shares, control, or voting rights over the target company. So understand this part. Person acting in concert, two parts are there. One is SEBI, the other is where SEBI means where the onus of proof would lie on the SEBI, and in the second part, SEBI is already presumed. So if you are not acting in concert, then in that case the PAC needs to establish the facts that, see, we are not acting in concert. And who all are being covered here? One is the immediate relative that I said. Next is the member of the promoter and the promoter group. Then the company, its holding company, subsidiary company, or company under the same management or control. So the group companies, then the directors or any person who is interested in the management of those group companies, right, or of the company, they all will be categorized as the deemed PAC. And the list does not end here. One is this part. The second part is you have mutual fund, you have collective investment scheme, you have venture capital fund, you have alternate investment fund. So all these funds, they are run through, all these funds, whether it's mutual fund, CIS, or venture capital fund, or alternate investment fund, they all are going to have sponsor, trustee company, and the asset management company, or there will be a manager. So they all are considered as one. So let's say there is a mutual fund, the sponsor of the mutual fund, the trustee company, and the asset management company of that mutual fund would be considered deemed to be PAC. So if the mutual fund asset management company is acquiring shares of a target company and the trustees are also acquiring the shares of the same target company, there is a by default presumption made by the SEBI that both of them are acting together and they are acquiring the shares of the same target company with the same intention. Similarly, the logic would be applied to the collective investment scheme or the venture capital fund or the alternative investment fund. So this is one part. So why I've segregated this way? One, of course, it was the space constraint. And the second is like this, you can actually understand, categorize the 1 to 4. You can also categorize as group company. If you want to recall it in the exam, I think you can just term it as group company, then immediate relative, and then you have this fund, right? All these can be categorized into one category fund. Don't write it in the exam. This is, I'm just telling you how you can remember. Okay, so fund, it's sponsor, trustee, trustee company, asset management company, manager. So this will be again helpful for you. Then you have the merchant banker and its client, who is the acquirer. Similarly, the portfolio manager and its client, who is the acquirer. The banks, financial advisors, stockbroker of the acquirer or of any person which is a holding company or subsidiary company of the acquirer, right? Where the acquirer is an individual of the immediate relative of such individual. So here also, if you will see, the banks, financial advisors, stockbrokers, even they are called as the person acting in concert. However, if they are providing services in their normal commercial activities, then in that case, they will not be called as a deemed PSC. But again, this needs to be established. Thereafter, you will find an investment company. So in this investment company, now understand there is also a proviso in this part. The proviso says nothing in this clause shall apply to the holding of units of the mutual fund registered with the board. Otherwise, what happens? There is an investment company or there is a fund. Now this, so let's say this is that investment company or this is that investment fund. They are acquiring the shares of a target company. And now you have this one individual, okay? This individual is also acquiring shares of this target company. Now you would say, what is the problem? The problem is this person has invested, okay? This person has invested 10% or more in this company. 10% or more in this investment company or in this particular fund. And this individual is acquiring the shares of the target company and this investment company is also acquiring the shares of the target company. So here SEBI would say that, see, you and this investment fund or this investment company, both of you are acting together and both of you are acquiring shares of the target company with the same intention. Therefore, you will be deemed to be a PSC. However, if it's a mutual fund, then again, there is no problem. They will not be called as a deemed PSC. So I hope the definition of deemed PSC is clear to you because it is important from your exam point of view. Whenever you get an answer, start with this, that the definition of PSC is segregated into two parts. First part where the onus of proof lies on SEBI, and the second part is the deemed PSC where the onus of proof to establish that they are not acting as PSC lies on the parties who are deemed to be PSC. And who are deemed to be PSC? The group companies and the employees, promoter and promoter group, immediate relatives. Then you have the fund and the sponsor, trustee, trustee company, managers, and the asset management company, merchant banker and its client who is the acquirer, portfolio manager and its client who is the acquirer, then banks, financial advisor, stockbroker of the acquirer. However, if they are providing services, not for all, only for the banks, right? If they are providing their services, normal commercial services with relation to the open offer, they cannot be called as a person acting in concert. And then you have the investment company in which a particular investor has invested 10% or more, and that investment company or the fund is acquiring shares of the target company and that individual is also acquiring the shares of the same target company, then in that case, they are deemed to be the PSC. One peculiar definition of shares, right? You will find it in the takeover regulation. So Companies Act shares means equity share, preference share. You have section 43. But in the takeover regulation, the shares has been defined and it says that share means the equity share capital of the target company which are carrying the voting rights, and it also includes any security which entitles the holder to exercise the voting right. So by default, if you see, is preference share capital, is preference share, is it shares under the takeover regulation? Answer is no. Why? Because preference shares do not have, so preference share is not an equity share. And second, they includes part say any security which entitles the holder to exercise the voting right. So does preference shareholder, do they have a voting right? Answer is no. So therefore preference shares are not shares in the takeover regulation. However, if you don't pay dividend to the preference shareholders for consecutive 2 financial years, then in that case, the preference shareholders also get the right to vote in all the resolutions of the company, section 47, right, of the Companies Act. In that scenario, even the preference shares will be called as shares. Otherwise, preference shares are not shares, but if preference shares, they get voting right pursuant to section 47, subsection 2, then in that case, they are also called as the shares. Also, there is an explanation here which says that the depository receipt. So for example, you have depository receipt, right, ADR, GDR, they are also considered to be shares. Okay. Let me give you one example here. For example, in a company, there are 1000 equity shares. Okay. And let's say there are 200 ADRs. Now, is the company having 1200 shares? Answer is yes. There are 1200 shares in the company. But ADRs by default do not have the voting right. Equity shares, they have the voting right. So what is the voting right in the company? The voting right, the total voting right is 1000, but the shares are 2000. Now understand, the intention of the lawmaker is to include the depository receipts into the definition of shares. That's the reason they have said, for the purpose of this clause, share will include all depository receipt carrying an entitlement to exercise the voting right. So they may not be getting the voting right now. So like I said, 1000 equity, 200 ADRs. So the voting right is only 1000 because these 200 ADRs, they don't have immediate voting right. The holders, they cannot exercise the voting right. But are they entitled to? Answer is yes. They can anytime convert these ADRs into equity share and they can exercise their voting right. But as of now, there are 1200 shares in the company. However, the voting rights are only 1000. Tendering period, I have already explained it to you. So this part, I think the definitions part, the relevant definitions part for your exam is this. And in the next video, I will start with the trigger part where I will cover regulation 3 and regulation 4 in detail. I hope you must have understood the introduction part and the definition part in this. That's it for this video. See you in the next part.